what is a junk bond? To me, I would say anything less than AAA is a junk bond. That's something wrong. That means, once the moment you say your credit worthiness is not 100%, your ability to repay is not 100%, then you're junk to me. But the market will say BBB is investable. It's not junk. BB is junk. That is the market definition. But to me, and I think all retail investors should say, anything less than AAA is junk. In fact, I'm saying don't even buy AAA bonds. It makes no sense.
A new episode on Let's Get Rich with Pattu, where we think it will be a complete full episode as normal, but we're also trying to make this episode into shorts because we see the data on YouTube shows that you guys consume shorts way more than our longer episodes. So this is our attempt at asking a wide variety of questions, rapid fire almost at Pattu, and Pattu has literally 1 minute to answer so that we can post them as separate shorts. Pattu, how are you doing?
I'm doing great and I'm looking forward to this. This is going to be new.
So here we go. Question number 1. Pattu, if I'm broke, what should I do next? What should I focus on? And what steps should I take to get out of this very stifling, suffocating feeling of being broke?
I think the first step is to tell yourselves, this is not going to happen again. I'm going to make sure I'm never going to be broke again. I'm broke now, but I'm never ever going to be in this position ever again. So that determination is very important. I've been in a situation like that before.
Me too.
And that's what I told myself. I'm never going to be able be in a position where I have to depend on others, try to borrow money or get into some kind of a debt trap. And then we slowly start by working hard and trying to increase our income and take it one step from there. So that's about what I can.
So increasing income should be our full focus and perhaps try to reduce all kinds of unnecessary expenses.
Yeah, that will automatically happen when you become broke. But the desperation that you feel, I think we should tell ourselves, never again. That is the driving force.
Cool. All right, end of question 1. Question 2. Pattu, why is it that you say so vehemently that mutual funds have no compounding effect?
The capital market does not. Any product that fluctuates does not. So we use compounding formula to understand the growth. That doesn't mean they actually compound. So compound interest is interest and then interest upon interest,
which is guaranteed.
Which is guaranteed when it's a fixed income instrument where you already know prior to investing what the interest rate is going to be. But that's not the case in the stock market. That if it goes up, comes down. And if you look at the all these compounding advertisements, they show you all how the stock market has moved up. But moving up is only one aspect of the stock market. It moves down. It moves nowhere. Those are also part and parcel of the stock market. And there's something called volatility bunching, where there is a big uptick is followed by a big downtick and vice versa. So given that there's really no compounding in the conventional sense in the stock market, we use compound interest formula to analyze and understand growth, but that doesn't mean that's what happens.
So we use it in retrospect to understand how it has grown, but
Precisely.
To look at the future, there's only fixed income that you can calculate.
Precisely,
with compounding interest.
Because the journey is unknown. After the journey, we can sit and do hindsight analysis. The hindsight analysis is what this idea these guys are talking about is compounding. That's not true what happens in real life.
Question 3. Pattu, can an Indian retail investor buy government bonds that are not Indian government bonds? If they can, which governments can we buy bonds for and how?
Technically, yes. You'll have to approach an international broker, a broker that allows buying and selling of foreign securities, equity, gold, or any kind of commodity as well as
Could
bonds.
you name a few?
Offhand, I don't know because I've not been looking at that. But there are a couple of them. I don't remember them offhand, but that's where you have to approach. But I'll be very, very cautious with respect to this because one guy once told me days after the Ukraine war had broken on, he said, I want to buy Ukrainian bonds now because they have huge interest rate. I mean, that's silly because the only reason why people want to buy international bonds is chasing after interest. And there are many countries that are broke. I mean, neighbors all around us are broke and their bonds would offer very high rates. But that's the last thing we should be buying. So I would say retail investors should never ever chase returns in fixed income space, in any space, but particularly in fixed income space. So it's a no-no for most guys.
Here's my next question, Pattu. If I buy an Indian government bond, and at the end of that term, and this might be a controversial question, at the end of that term, they do not pay me, what is my recourse as a retail investor?
I think if the Indian government does not pay you back, that recourse would be the very last thing on your mind, because that means the economy is gone. The rupee is no longer valid, and there are huge problems. You will be having problems finding your next plate of food and water. So I think, yeah, so there are bigger fish to fry at that point in time.
Basically, Pattu saying a very silly question.
It's not. It is, but it's something that, I mean, there are risks you can control. This is something that this is beyond you. I mean, so I think I would not lose sleep over it.
Next question. A new announcement by SEBI, which was about cutting corporate bonds face value, which has now reduced to 10,000 rupees. How does it affect us as retail investors?
It's going to entice more retail investors to buy corporate bonds. But again, what I just told in a previous question, they will start chasing interest rates, that they will start chasing after low graded bonds which offer higher returns, and that is always a bad thing. I would say retail investors should not buy corporate bonds directly. They should stick to safe bank FDs or gilt bonds if they want an income.
And also stick to debt mutual funds, which buy corporate bonds, and will that be safer?
Yes. By definition, the corporate bond is a high quality credit rating bond fund. So that is a good option at any point in time rather than a corporate bond.
Here's my next corollary question. Now that SEBI has reduced face value to 10,000 rupees for corporate bonds, is there any advantage of buying direct bonds at small amounts of money compared to buying a debt mutual fund which invests in corporate bonds?
See, the thumb rule is, if you are building wealth, don't buy any bond, because the bond will pay out the income and you have to pay tax on that, and then you have to reinvest it again. It's a hassle. Buy bonds, safe bonds, if you need an income, if you're taking a break from work, or if you're saying I want to start a company, but I want income for the next 5 years, 10 years until the company picks up, then you buy a bond, or naturally after retirement. Otherwise, never buy bonds. In a debt mutual fund, as we discussed earlier, you pay tax only when you redeem and only for the amount you redeem. And therefore, overall, the taxation will be attractive. Although the tax rate is the same, the amount of tax you will pay in a debt mutual fund will always be lower than in an FD or a bond. So debt funds are always better.
But to have debt mutual funds got ratings, just like the underlying bonds are rated, sovereign, AAA, etc.
So these all mutual funds have a star rating. That is the ratings given by portals based on their risk, reward, and the portfolio and so on. But a debt mutual fund holding bonds will have an average credit rating based on the credit rating of the individual bonds it holds and the amount. So it's a weighted average of the credit profile. So that is what it will have, and that doesn't actually tell you. So that's like the idea about a river and a 5 feet guide trying to cross a river which is on average 4 feet. So that's a very poor notion. The average credit rating of a bond is a poor notion, because you don't know how many what are the bonds that are there, which bonds are actually bad, good, and so on. So you should actually look deep into the portfolio and look at the exposure to different types of bonds and not look at the average rating.
And so apart from average rating, there's no other way apart from deep diving and seeing the underlying assets to determine the quality of a debt mutual fund.
Yeah, the thumb rule is always deep dive into the portfolio of a debt fund. Equity fund, not so much. Don't need to do that so much. But debt fund, definitely, yes, because it can give you shocks. Suddenly they buy bad bonds, the debt fund now crashes and you have no recourse at all.
Here's a question that popped up from one of our previous episodes, Pattu. How do passively managed debt mutual funds work? I can understand how passively managed equity mutual funds work, but how does a passively managed debt mutual fund work? Because the entire concept is to trade in bonds.
So there are two types of debt funds, passively managed debt funds. One in which they keep the average maturity. We talked about the average maturity of the bond portfolio. They keep that more or less the same. So they'll be as some of the bonds mature, they'll be buying new bonds of the same tenure and so on. So more or less the average maturity will more or less be the same. That's an open-ended passive debt fund. Of course, there will be a index curator like the NSE or the BSE that offers a index based on the idea that the AMC comes up with, and they will tell you which bond should be there and which bond should not be there. So the fund manager will just follow that. So that's the passive part of it. They will not do any active management. The index curator will tell you what to buy or not, but they will ensure that the average maturity is more or less the same.
And this is something they pay a huge premium for from the indexes.
Oh yeah. So when these NSE and BSE curators talk about active versus passive, they also have a kind of conflict of interest because they want the AMCs to purchase factor indices from them. So the factor indices are in between the active and the passive regime. So they will do the active management, but the AMC will do the passive investing. Right. So there's a conflict of interest there, but that's not what we want to do. This is one way of open-ended passive debt funds. The other way is what is known as a target maturity fund, where you buy, let's say, 5-year bonds and you just sit on it. You don't do anything. So
no trading.
No trading. Unless there is some special circumstance where the bond fails and so on. But typically no trading. In the first year, we talked about how the NAV volatility will be higher longer the tenure. So in the first year, the fluctuations will be more because there's 5 years left for maturity. In the next year, there'll be 4 years left, so the fluctuations will come down and then it'll keep coming down. So at the time of maturity, the bonds will all be sold, converted to cash and either given to the investors, or they will ask the investors if we can continue it as an open-ended fund. So there are two types of passive debt funds.
But if there's no trading, Pattu, why is there volatility even in the first year?
No, the trading is you don't trade, but the market will trade. So the SEBI mandates that whether you trade or not, your NAV should be marked to the market price.
Pattu, how often do governments or corporates offer new bonds? Is there a thought process behind that? I mean, how many bonds in the corporate world exist, for example? I want to understand on what basis they issue a new bond and how regularly.
So this is a very complex idea. Somebody issues a bond when they need money. And the government does it. The government has no problems about, they can do it at will because they are more or less in charge of the interest rates directly or indirectly. The corporate themselves, they will do it depending on the interest rates that are there, the prevalent interest rates at that time, and also their own needs and how financially stable they are. So it's a very it depends on the circumstances of each corporate.
And does the Indian government, is there a record of how many bonds that they've issued in the last, say, 3 years on a yearly average?
The RBI site will have this. It will not be easy to find in the manner that you asked, but we'll have to dig into it and look at it.
So here's a fun question, Pattu. There's this entire world of perhaps people who enjoy investing in companies, enjoy investing in, junk stocks or penny stocks, as we call them. Is there a similar world for lower rated bonds? And how does a retail investor get into that? I know you'll say, don't get into that, but does this world exist, firstly?
The world certainly exists all around the world. I checked in India. I'm not sure if there's a place that peddles junk bonds along with other bonds. I'm not sure that it is available as of now. I may be wrong, but that's my understanding. But what do you call what is a junk bond? To me, I would say anything less than AAA is a junk bond. That's something wrong. That means, the moment you say your credit worthiness is not 100%, your ability to repay is not 100%, then you're junk to me. But the market will say triple B is still tradable. Triple B is investable. It's not junk. Double B is junk. That is the market definition. But to me, and I think all retail investors should say, anything less than AAA is junk. In fact, I'm saying don't even buy AAA bonds. It makes no sense. We
Just
talked
sovereign,
about, yeah, just buy sovereign. You want income, buy sovereign. You sleep peacefully. If you want, you buy a debt fund that buys. They will do the management, and the risk becomes much less because there will be spread. When you buy a AA bond or an A bond, you're going to put a sizable chunk of money there. Otherwise, the interest is less. But the debt fund, they will distribute. That's why I keep saying most people disagree with me. Debt funds are wonderful products. Equity funds are not so special. Debt funds are more special than equity funds if you know how to use them.
Here's a counter question then. Who exactly in the world is buying that 27% government bond from the Argentinian government? I seriously want to know. And what are the chances, say from 1 to 100%, of you getting your money back?
See, there's always guys who are chasing after this risk premium. And see, in a government, they will print more money and kind of make good on their debt. I'm not savvy enough to tell you who does it, but I'm sure there are financial institutions who can. They'll take a very small exposure, 1% exposure, 2%. International, pension fund managers can do it. Because if that 1% defaults, you won't even know. The NPS for the National Pension Scheme has got a portfolio size that can fill an entire 40 pages notebook. And it has seen defaults.
You're saying international government bonds, 40 pages worth of.
No. I'm talking about our national pension scheme.
But where are they investing?
They're not investing in foreign bonds. They're investing in, I'm saying it's a huge portfolio. So imagine if an international pension fund manager or anybody else from but of course, for them, it's the national pension fund for that country. They can buy a 1% of Argentinian bonds. If that defaults, it will not even be a blimp in the NAV.
But if it pays out,
if it pays out also, it will not be a blimp. It will be a very small. You're taking only 1% exposure. So the idea is they take such exposure so that the overall return, they don't expect every country, every government or company to default at the same time. They can, but they don't expect that. So generally, that's how they beat the market. They get a little premium above the market. So there's always a buyer for this.
So you're saying governments around the world defaulting on their bonds is common practice. It happens. And then the second half of that question is, what will happen if the US defaults?
So Russia has defaulted. That's the most recent. That is before. I mean, it defaulted after the Ukraine war started, but it defaulted even before that. I think many other companies. I think, if I'm not sure, England has defaulted. I think in the 70s, if I'm not wrong, they had to go to the IMF for a bailout, just like Pakistan is going.
And does default mean it's like a write-off?
Yeah, the IMF and the World Bank does these kind of things. They write off debt, and in fact, there are economists who believe debt should be written off from time to time. They'll just forget about it. Okay, you made a mistake. You goofed up. We goofed up. Let's just move forward. But that happens. Yeah. It happens from time to time.
And what would happen, and what are the chances of the US government defaulting on their bonds?
If they take on, there are economists who say there's a very strong possibility of that happening. If that happens, then I would say many of our currencies would become stronger. Mm-hmm. And other countries would become, the economy of the other countries would suddenly get a boost if the US defaults. It's not as if they are going to collapse or anything, but if the dollar will weaken significantly, then the rupee will gain, the other currencies will gain. So, and then the other countries can kind of tell the US what to do and what not to do. Because they have been the bully so far, they can no longer be the bully. So there'll be a shift.
So will there be a situation where the US government has to listen to other governments, and will they listen? But that's it on this episode of Let's Get Rich with Pattu. These amazing short answers will continue next week. Till then, Pattu, thank you so much, and see you next week.
Bye-bye.